Annuities are generally marketed as a safe investment option where you can put your money somewhere, it grows, and you get guaranteed income whenever you decide to turn that on. Most buyers of annuities never see the truth of what really happens inside of those contracts. Join us today as we discuss why annuities might not be the best investment option for you.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Jamie Burton.
Happy to have you along. Hey, Jamie is one of our senior advisors up in the Lafayette, Indiana office. She's a graduate from Purdue with a degree in financial planning, and it's just an absolute joy to have you on the show. Today, our theme in all of our segments is going to be buyer beware. We're going to talk about different investment vehicles that people choose to use and sometimes lose, and we'll go from there. Remember, if you're listening on WIBC or some of the other outlets that are out there, you're only hearing part of the program. If you want the whole show, you can go to considerthisprogram.com, or anywhere you want to download a podcast, you can go to considerthisprogram.com. We break it into multiple different areas. So there's 5 critical elements that we believe are important. It's our trademark process called the Family Focus process. We start with your financial vision, and then we go to your life after work, the annual tax planning, the investment playbook, life happens. Those are the good, bad, and ugly things. And then legacy planning. Then there's a 6th channel you'll also be able to find on YouTube that's called The Better Giver. Jamie is responsible for running that part of our program. So with no further ado, we are talking about annuities. And Jamie, what is an annuity?
So an annuity is an insurance contract, and this contract functions that you put money in it today with the idea that in the future you are going to turn on a guaranteed income whenever you so decide to do.
So like a pension that somebody would have had in the old days.
Yes, yeah.
In fact, when General Motors shut their pension down, they sold off the pension plan to Prudential, who is an insurance company. Mm-hmm. So an annuity has to come from a life insurance company by law. And then they provide these contracts. So there's many different contracts, though, right?
Yes, yeah.
So
yeah, there's a lot of different contracts you can get. So one of them would be a fixed annuity with immediate income. So you could put money into the contract today and automatically turn on an income. Then there are fixed incomes where you fixed annuities that you have income in the future. So you get a fixed rate of income that you would take in the future once you did turn that annuity on. There's variable annuities. So that's where you put money into a contract. It's invested in the market, whether it be in stocks or bonds. So it kind of fluctuates with what the market's doing. And then in the future, you get an income based on what those inside investments do.
So it's a chassis for all intents and purposes that holds every different type of investment, cash, bond, stock, right? Even some real estate in some cases when you get into some of them. Do they have different fees and expenses?
Yes, yeah. All contracts come with their own list of jargon of what exactly you pay inside of each contract, different fees, different expenses based on what you choose in the contract.
So what's one of the popular ones that you see in the office when people come in?
Yeah, so one of the most popular ones is a guaranteed income rider with a death benefit on the end of it.
So what's it look like? How does that work?
So that means that once you turn on the income, you don't automatically lose that death benefit in the future. So the death benefit gets paid out based on how much money that you've taken out of the annuity. Now,
you just heard Jamie tell you everything that is accurate about the contract, or many of those contracts. They're all different, right? What sounded bad? Why wouldn't I want one of those?
They're very, very complicated. Most people who buy an annuity, they have never actually looked at the contract. And if they did, they wouldn't understand the majority of what is laid out inside that contract. The biggest problem with annuities is they're very, very expensive. So they have really high upfront costs to get into the annuity. So a sales charge that gets paid out in a commission. And then the underlying fees of paying for different riders that you have on the policies. If you have a variable annuity where you have stocks and bonds and cash inside of that annuity, you're paying a charge to buy into those assets. And if you ever rebalance, you're paying more charges. There's management fees. There's all sorts of fees that are underlined in an annuity that most people don't understand that they're paying.
Including, and I hate to say this, many times the people who sell the product.
Yes.
So when you ask me what something cost, if you ask me what my car cost, what are you trying to get at?
What you paid
what I
Right.
paid, or does that count sales tax? Does it count the gasoline? Does it count the oil
No.
changes? Those are
Right.
what we call carry costs. So you said something that some people I know in the insurance industry would argue with you. You're right. You said that there were high upfront cost. Right. My challenge with the annuities, for the variable annuities, isn't necessarily the high upfront cost. It's the carry cost. Right.
Right.
When my Jeep takes regular gasoline. Right. When I had my Infinity. Right, you had to put the super duper ultra pro, and sometimes it's 50 and 60 cents more a gallon. Right,
Yep.
it's the carry cost that get in some of those annuities that people really don't understand. The other annuity that you left out, one that I still think is a predatory product, is called an exchange based, an indexed type of an annuity where the sales pitch goes like this. Jamie, I'm going to get you an equity indexed annuity, and we're going to put your $1 million retirement in this. And if the market goes up, you're going to get 70% of what the market did, but you can never get less than 2 or 3%, whatever's the base in the contract. Does that sound like a great idea for you?
Yeah, sounds good.
And so the challenge is when people look at the market, and believe me, I've seen all of the sales pitches. They'll talk about the historical return of the S&P 500, but they forget to take out dividends. And when you buy an equity indexed annuity, folks, and they talk about a 10% average return for the S&P 500, first of all, it's a little bit below that. But second of all, that's counting the dividend that's going into it. And when you pull that dividend out, what you've done is made a feel-good decision for today, which is what tends to happen, fear-based, so buyer beware, do not choose to lose, right? And one of the things you've trapped yourself into is inflation, and 20 years from now, you may or may not be surviving the inflationary battle that could be coming.
Right.
So what's a better alternative?
So a better alternative is really to look at the assets that you have, structure it in a way, purchasing individual stocks or ETFs or cash, structure it in a way that it makes sense for your risk tolerance, and then really come up with a good payout strategy in retirement to unwind those assets. So you still can get an income stream, but you have more control over it, and you have a lot more flexibility with it.
And flexibility is key, right?
Yes.
I mean, it is. We're not at Valentine's Day yet, guys, but be prepared, right? One of the things I always talk about this time of year is that, somebody's going to ask you how you met, right?
Yep.
And, I always ask that about all of your investments. How did you meet? And when I see most people who have bought annuities, the bottom line is they met out of a fearful conversation, right?
Right.
Or somebody that they liked and trusted that didn't necessarily know any better. Right. So I think flexibility is key. I've always told people that, I married my wife 33 years ago. I only date my investments. Right. So every time we put money into an investment, whether it be a stock, a bond, an exchange traded fund, we want to know what our exit strategy is. And you really need to know that. So there's about 3 typical exit strategies in an annuity. What are they?
Yeah, so you can exit the annuity early, and you are going to be paying lots of fees that associate with leaving the annuity early. You can annuitize the annuity, which is where you start turning on those payments, or you can do typically annuities have a 10-year rule, so you can withdraw your funds over 10 years without having to pay any surrender charges.
Any surrender charges, but what about taxes?
Yeah, we still owe taxes, definitely.
Right. So what you need to catch from that, or what Jamie was trying to tell you, is an annuity is a chassis. So we're going to talk about mutual funds. We're going to talk about exchange traded funds. We're going to talk about bonds and stocks and opportunity cost on this segment, on the show. But what you need to know is an annuity is a chassis. Any of those investments that we just mentioned can go inside of the chassis. Sadly enough, one of the chassis will also fit into an IRA. This is something that typically should not happen in any way, shape, or form. One of the advantages of an annuity is that by definition you have tax-deferred growth. But if you have an IRA, you already have tax-deferred growth, or at least tax deferral in that mechanism. So what you're paying for is part of the chassis that you don't need, right? You don't need a dually if you're not going to pull a trailer, right? And that's what happens many times is we see people make an investment, typically out of fear, or somebody they liked and trusted who didn't necessarily know a lot in the investment world that was going on. Maybe it was the only option they had, the only arrow in their quiver. And what Jamie's trying to tell you is you need to have your options open to be able to be flexible as things change, to understand the tax code, to understand the investments. And here's what I would invite you to do. Two things. One, you can go to our website at yourlifeafterwork.com. Download a checklist. If you're going to buy an annuity, we put together a series of questions that you need to be able to answer before you commit to buying that contract, before you get into that relationship. It's free. It's a service that we provide for you. While you're there, you can also go to yourlifeafterwork.com and get signed up for a next steps meeting. Jamie will sit down with you, help you review any decisions that you have to make today. She's going to give you things that you need to consider right now about your finances. Secondly, she's going to give you things to consider in the future. And lastly, if you choose to partner together, she's going to give you things that FEG will do for you, and she's going to put them into writing. So again, I would go to 800-928-4001, ask for Brittany, or go to our website at yourlifeafterwork.com, get signed up for your next steps meeting, and don't forget about the checklist. Get one. If you're going to buy an annuity, you want to know the questions that are on that sheet, and somebody better know the answer.